Please see the full disclaimer on your screen before we begin.
There's a quote that goes, if you're listening to the chatter from the high-rise boardrooms in New York or Chicago, you'd think the storm has passed. But it doesn't always reflect what we're seeing here on the gravel lots. And honestly, that just perfectly nails the massive disconnect in commercial real estate right now. We are looking at a profound split in the market. There's this stark contrast between the mainstream narrative of a seamless economic recovery and the really gritty day-to-day reality on the ground for mid-market investors. Let's actually dive right into this split reality. We're looking at a real underdog story today. On one hand, you've got your Class A and institutional properties. These are the shiny luxury trophy assets, where capital flow is actually getting back to normal. But on the other side, we've got the Class B and C mid-market properties, the multifamily units, the hospitality corridors, the gravel lots. Over here, folks are cautiously optimistic, but let me tell you, it's not because of some magical drop in the Fed funds rate. That optimism is earned entirely through sheer operational grit. So, welcome to this explainer. Today, we're unpacking the real, tactical strategies that B and C class property owners are using to survive and actually thrive right now. Because look, while the flashy headlines love those shiny skyscrapers, it's the B and C class space that's the literal lifeblood of local economies. Figuring out how this space ticks is exactly how you spot the real, uninflated value in today's market. We're skipping the boardroom buzz and going straight for the ground truth. Here's our game plan to map out this market shift. We'll be looking at the real estate divide, the operational squeeze, strategies for survival, the risk perception gap, and finally, navigating the road ahead. Let's jump right in. Starting off with Section 1, the real estate divide. Let's talk about why the mainstream headlines might be messing with your perspective. When those boardroom execs confidently announce that the worst is over, they're talking about one specific thing: institutional loosening. Basically, capital is flowing normally again, but almost exclusively for the big box players moving luxury trophy assets. It's kind of like a VIP club with a super strict velvet rope. It's an isolated slice of the market operating with completely different safety nets than the rest of the playing field. Which brings us to Section 2, the operational squeeze. Because man, the B and C class owners, they are fighting a completely different battle. While the A-class crowd is throwing in high-end tech and fancy tenant amenities, mid-market owners are locked in this brutal two-front war. Front number one, operational overhead. Imagine a 15% spike in utility costs. When your margins are already razor thin, that isn't just annoying, it's a direct existential threat to your debt service coverage ratio. Literally, every extra buck you spend keeping the lights on is a buck you can't use to pay the mortgage. And in this market, that is incredibly dangerous. Then there's the second front of this war: deferred maintenance. If you own property, you already know that ignoring a weird noise in an aging HVAC system can snowball into a catastrophic $100,000 failure practically overnight. That is exactly the kind of massive unexpected hit that'll completely stall a refinance or kill a sale dead in its tracks. You just can't afford six-figure surprises right now. And if all that wasn't enough to squeeze you, let's talk about insurance. In some regions, owners are watching their insurance premiums absolutely skyrocket by 20 to 50%. When you stack that kind of premium hike on top of utility spikes and brutal property tax reassessments, the pressure on the bottom line is just absolute. So let's move to Section 3, strategies for survival. How on earth are savvy owners handling all this pressure? What are the boots-on-the-ground investors actually doing right now to protect their margins? Well, they're ditching the flashy tech amenities and locking down 3 super disciplined operational pivots: energy audits, preventative maintenance, and adaptive reuse efficiency. Let's break these down one by one. First up, the energy audit pivot. You have to dig way deeper to fight off those utility spikes we just talked about. The days of just screwing in some LED light bulbs and patting yourself on the back, those are long gone. Savvy owners are fiercely analyzing their HVAC performance and beefing up their building envelopes. They are aggressively sealing up physical gaps to make absolutely sure not a single dollar of heating or cooling is leaking out of the building. Which flows right into strategy number 2, preventative maintenance. The old fix-it-when-it-breaks mindset is completely dead. Right now, survival means building rock-solid partnerships with local vendors and running strict, tiered maintenance schedules. By actually staying ahead of the wear and tear, these owners are dodging those catastrophic, deal-killing, six-figure failures we discussed earlier. And step 3 is fascinating, particularly if you're looking at the hotel-to-housing space. It's all about adaptive reuse efficiency. Basically, using lean construction to solve for the missing middle, that huge gap between subsidized housing and luxury apartments. So instead of overbuilding from scratch, these investors are taking existing structural footprints and retrofitting them. It keeps their cost bases incredibly low, letting them comfortably ride out the volatility while the broader market catches up to demand.
All right, section 4, the risk perception gap.
This brings us to a huge question. Why are institutional lenders happily throwing cash at Class A properties, but suddenly turning their pockets inside out for B and C assets? It boils down to risk perception. Look, giant institutional players have massive balance sheets. They can eat a 50% insurance hike without even blinking. But the mid-market folks, those boots-on-the-ground investors, feel the sting of every single property tax reassessment and every single insurance bump. Because they don't have that massive corporate padding, lenders look at them and see way higher risk. It effectively chokes off their access to easy capital. But here's the crazy part. Even with that lack of capital, there's a ton of genuine optimism in this space. And you might be wondering, why? Simple. Because demand for workforce and senior housing is sitting at an all-time high. Sure, the buildings are older. Sure, running them requires a whole lot of grit. But the undeniable necessity of these properties gives investors a real reason to stay positive. They aren't placing bets on some fickle luxury trend. They are betting on the absolute bedrock of the economy. At the end of the day, people are always going to need a place to live.
Finally, section 5, navigating the road ahead.
So, if you're trying to navigate these choppy waters yourself, what data should actually be driving your decisions right now? Because we already established you can't rely on mainstream headlines. Well, first, Moody's Analytics is an absolute must for tracking the widening vacancy rate gaps between Class A and the rest of the market. Second, the Trepp podcast is fantastic for deep dives into CMBS data. That's commercial mortgage-backed securities. So you can see exactly where the smart money is actually flowing. And lastly, the Urban Land Institute's Emerging Trends gives you a literal blueprint for turning struggling assets into high-yield community hubs. These are the tools that'll help you spot the real opportunities before anyone else. I want to leave you with a really powerful thought from our source material today. The institutional tide is rising, but if you're operating in the B and C class space, you can't just wait for the water to lift your boat. You have to be the one at the helm, tightening the seals and watching the horizon. I love that. It perfectly captures the core takeaway of this explainer. Surviving and thriving in this space doesn't happen by accident. It demands constant, proactive grit. You've got to actively manage those margins. It's a tough market out there, for sure, but it's an incredibly active one that highly rewards discipline and operational excellence. Which leaves us with one vital question. Are you letting the macroeconomic tide dictate your future, just hoping the recovery somehow trickles down to you? Or are you actively at the helm, tightening your own seals, optimizing your operations, and steering your investments toward success? Honestly, think about what you can tighten up in your own operations today. Thanks so much for joining me on this explainer, and keep your eyes on the horizon.